Global currency markets have once again turned their attention to India as the nation's currency, the Indian rupee, faces a renewed wave of depreciation. Observers outside India note that the rupee's decline has become a recurring headline, raising concerns among investors, economists, and global market analysts. Recently, the rupee fell past the 87 rupee mark against the US dollar, hitting its weakest level in several months. While currency volatility is a common phenomenon in emerging markets, this particular drop stands out for two reasons. The rupee has been the weakest performer among major Asian currencies, and its recent slide reflects both global pressures and domestic vulnerabilities. But is this just a dip or the start of a currency storm? Stick around till the end to find out if the rising India can ever catch up to the mighty US dollar. In late January, the rupee's fall accelerated after a combination of global and domestic triggers. Market reports indicate that foreign investors pulled out approximately $1.5 billion from Indian equities in July alone, part of a larger trend of capital flight. This outflow came alongside fresh political and economic noise. Former U.S. President Donald Trump publicly threatened 20 to 25% tariffs on Indian exports. Even if such statements are political posturing, global investors often react immediately, fearing the downstream effects on trade, manufacturing, and currency flows. Analysts observed that the Reserve Bank of India stepped in to stabilize the currency through measured interventions, but avoided large-scale market support. This approach, according to currency strategists, reflects a long-term preference to conserve foreign exchange reserves rather than burn through them defending the currency at any cost. The rupee's fall looks even sharper when stacked against its Asian neighbors. Among the 7 major Asian currencies that markets track closely, the rupee came in as the worst performer, sliding about 1.1% in January alone. Here's how the region stacked up. The Indonesian rupiah recorded the second biggest drop, followed by the Philippine peso in third place. In contrast, the Chinese yuan showed resilience by actually gaining value, while the South Korean won emerged as the month's top performer. Meanwhile, both the Malaysian ringgit and the Thai baht held largely stable, avoiding any major swings. This comparison tells global analysts one thing loud and clear. The rupee's weakness isn't just because of a stronger US dollar. India-specific factors are clearly weighing it down. A review of the USD-Indian rupee exchange rate over the past 12 months shows a clear stepwise decline rather than random market fluctuations. Toward the end of 2024, the downward slope became steeper, signaling accelerated depreciation. Stretching the timeline further, over the last 5 years, the rupee's weakness has been a persistent trend. Since early 2021, the currency has faced continuous pressure, and the recent months represent one of the sharpest phases of depreciation in that period. Global currency watchers say the Indian rupee's fall isn't just about the US dollar getting stronger. It's also about what's happening inside India's economy. The first big factor is India's trade deficit. India buys a lot more from the world than it sells. Every shipment of oil, machinery, or electronics has to be paid in US dollars. In November 2024, that gap widened to $37.8 billion, one of the highest in years. When demand for dollars is this high, the rupee naturally feels the pressure. The second factor, capital outflows. Foreign investors are pulling money out of India's stock and bond markets. In just January 2024, $9.9 billion left the country. And here's the thing. Every time they sell, they convert rupees into dollars. That double effect, less money coming in, more money going out, weakens the rupee even faster. And finally, slowing GDP growth adds to the story. India grew 7.8% in the first quarter of 2024, then 6.7%, and by the third quarter, just 5.4%. Still strong by global standards, but below India's own targets. For foreign investors, that's a signal to stay cautious. All of this combined shows why the rupee is under so much pressure. It's being hit from all sides at once. The Indian rupee's decline isn't just a headline. It's a story with real consequences. Every barrel of oil, every fertilizer shipment, every smartphone now costs more in local currency. And those higher costs, they eventually ripple through transport, factories, and finally, to everyday people. International investors think in dollars. So even if their Indian investments perform well, a weaker rupee cuts their profits once converted. Over time, this discourages new inflows. Companies that depend on imported components, electronics, telecom, even electric vehicles, feel the squeeze as input costs rise. So is the rupee crashing? Not quite. From a global analyst's perspective, it's not a freefall, but a structured depreciation. Many emerging markets face the same story whenever the US dollar strengthens, or when American interest rates rise, pulling capital towards safer shores. But here's the difference. India's own structural challenges amplify the pain. Heavy import dependence, persistent trade deficits, and foreign investors pulling back all make the slide feel sharper. Yet within this challenge lies opportunity. India remains one of the fastest growing major economies. It has a young, tech-driven workforce and massive potential in manufacturing and infrastructure. India's next big leap will come from turning Make in India into real, global-scale manufacturing, the kind that fills ships with electronics, semiconductors, and high-value goods heading out to the world. At the same time, keeping foreign capital inside the country is key. Investors stay where policies feel stable and predictable, where they know the rules won't change overnight. Equally important is diversifying trade relationships. When an economy relies too heavily on a few partners, even a single tariff or sanction can send shockwaves. Building broader global ties gives India a safety net. And through it all, the government must balance growth with discipline, spending enough to drive progress without shaking investor confidence about rising debt. These steps together could transform today's currency pressure into tomorrow's opportunity. The fall of the Indian rupee is real. Charts and headlines cannot deny it. But to stop there would be to miss the larger picture entirely. India remains one of the world's fastest growing major economies, a nation of over 1 billion people in constant motion, driven by ambition, innovation, and resilience. Currency dips are only snapshots in a much bigger film. For global analysts watching closely, these fluctuations are a reminder of how dynamic India's market truly is. Economic momentum is rarely a straight line. It surges and slows, bends and pivots, yet continues forward. And for India, forward has always meant upward in the long run. This is a country with deep structural strengths that short-term volatility cannot erase. Its young and skilled workforce fuels industries from software to manufacturing. Its digital ecosystem, among the largest in the world, connects small businesses to global markets faster than ever before. Its government continues to invest in infrastructure, logistics, and industrial corridors, planting seeds for the next decade of expansion. History has shown that India does not crumble under pressure, it adapts. Every economic slowdown, every market shock, every currency dip has eventually been met with a rebound, often stronger than before. For international observers, this is the defining trait of the Indian economy, its ability to transform challenges into catalysts for growth. The question for India is not simply, will the rupee fall more? Markets will always move. Currencies will always fluctuate. The deeper question is, will India rise strong enough to make it matter less? Global analysts increasingly believe the answer lies in India's ability to stay the course. Building resilience through smart trade, strong manufacturing, policy stability, and structural reforms will define whether these currency shocks become footnotes in a larger growth story. And that growth story is still being written. Across its cities and towns, in tech hubs and rural workshops, in policy rooms and startup garages, India is pushing forward. Its economy is learning, iterating, and adapting with every cycle. A stronger, self-reliant India is not a distant dream. It is already taking shape. For a country with ambition stitched into its DNA, today's volatility is not a verdict. It is a test. And if history is any guide, India does more than survive such tests. It emerges stronger, more competitive, and more confident on the global stage. The rupee may dip, headlines may shout, but the nation's trajectory, it continues upward, one step, one reform, one innovation at a time. And in the grand arc of its story, that momentum is what truly lasts,